China just lost billions in Venezuela, and most analysts still don't understand how. This isn't financial hyperbole. It's the stark reality playing out at the intersection of global power, oil markets, and sovereign debt. Estimates now suggest Venezuela still owes China at least $10 billion in outstanding oil-for-loan obligations dating back over a decade of lending, and some assessments push that figure toward $19 billion when you factor in unpaid interest and arbitration claims. To many outside the Beltway and Beijing's finance ministries, China's involvement in Venezuela once looked like a masterstroke, a rising superpower securing discounted energy supplies and extending its global economic reach. But here's the contrast no one saw fully coming. What most people thought was an unbreakable financial juggernaut, China's investments were too big to fail. The hidden truth is far more complex. A collapsing Venezuelan state, an economy in freefall, and recent U.S. intervention that shifted control of Venezuela's oil sector have fundamentally altered the calculus. This isn't just a story about bad loans or failed contracts. What happens next will reverberate through global markets, emerging market debt strategies, and the broader strategic rivalry between Washington and Beijing. If China's Belt and Road confidence can be shaken here, the implications ripple outward, from sovereign credit risk pricing to investor strategies for commodities and geopolitical risk. So ask yourself, what happens when the world's biggest creditor runs head-on into an economic black hole? And if this shakes investor confidence in Chinese lending, how will global finance adjust? These aren't hypothetical questions. They're unfolding in real time, and the answers will define the next chapter of power and money on the world stage. To understand how China ended up losing billions in Venezuela, we have to go back to the early 2000s, when this unlikely financial partnership was just beginning, and, at the time, seemed remarkably promising for both sides. In 2001, Venezuela became the first Hispanic country to enter a strategic development partnership with China, setting the stage for an explosion in trade, investment, and lending that would define the next 2 decades. During the Hugo Chavez era, Caracas embraced Beijing with open arms. Both ideologically and economically, China saw Venezuela as a key partner in Latin America, a source of energy, and a foothold in a region traditionally dominated by the United States. Between 2003 and 2012, bilateral trade expanded nearly 24-fold, and Venezuela became one of China's top suppliers of oil. The core of the relationship was oil for loans deals. China's policy banks, especially the China Development Bank, provided tens of billions of dollars in credit, intending to be repaid in Venezuelan crude oil. These were massive contracts, $20 billion in loans agreed in 2010 alone, plus infrastructure funds and joint investment vehicles, all designed to supposedly guarantee both oil supply and strategic influence. At the time, the arrangement looked like a strategic marriage. China got energy security and geopolitical presence. Venezuela received capital for social programs and development projects. It was a financial marriage built on oil, but with shaky foundations. Venezuela's economy was heavily dependent on oil revenue and lacked diversified growth, a risk that was barely acknowledged in Beijing's early optimism. Fast forward to today, and the contrast is striking. What once seemed like a robust strategic alliance is now a risk-laden legacy of loans that Venezuela struggles to repay, with Beijing increasingly cautious about extending fresh capital amid systemic economic collapse in Caracas. China thought it had oil under contract. What it got instead was a political quagmire. The logic behind Beijing's Venezuela strategy was simple on paper: lend billions, get repaid in crude, bypass dollar markets, and lock in long-term energy security. But the mechanism that was supposed to guarantee repayment is exactly where the system broke down. Most of China's exposure came through oil-backed loans issued by policy banks, designed to be repaid not in cash, but in barrels. As long as Venezuela could pump, ship, and export oil, the debt would quietly service itself. The problem was that Venezuela's economy collapsed faster than its debt obligations. Mismanagement, corruption, sanctions, and capital flight hollowed out the state. Production at PDVSA fell by more than 2/3 from its peak, starving the very repayment channel China depended on. As oil output plunged, repayment schedules stretched, then quietly failed. Tankers arrived late, or not at all. Refinery quality issues reduced the value of shipments that did arrive. Meanwhile, Venezuela defaulted on multiple international obligations, pushing the country into financial isolation. China suddenly found itself as one of the few remaining creditors. but with little leverage. The critical mistake was collateral. Unlike traditional lenders, China did not seize assets, restructure aggressively, or enforce repayment through courts. It relied on continued political stability and oil flows, neither of which materialized. Today, estimates suggest Venezuela still owes China between $10 and $19 billion, a meaningful sum even within China's vast overseas lending portfolio. Officially, the goal was influence and energy security. In reality, China ended up with reduced oil flows, unpaid loans, and declining control. A case study in how geopolitical risk can quietly erase billions without a single default headline. This isn't just finance. It's a chess match between superpowers, and Venezuela became one of the board's most volatile squares. As China's position weakened, the United States re-entered the picture not as a lender, but as a strategic enforcer. Recent U.S. actions, including direct military involvement and tighter control over key oil infrastructure, fundamentally reshaped who controls Venezuela's energy future, and by extension, who gets paid. Here the contrast is sharp. China's preferred tools are loans, diplomacy, and long-term economic entanglement. Beijing builds influence slowly, betting that time and capital will convert into loyalty. The United States operates differently. Through sanctions, legal authority over global dollar clearing, and now hard power on the ground, Washington can instantly alter the balance of control. In Venezuela, that leverage mattered. As U.S. influence expanded, oil flows were redirected, repayment pathways were disrupted, and China's informal guarantees evaporated. Beijing suddenly faced a dilemma: escalate and risk direct confrontation, or absorb the losses and recalibrate. So far, it has chosen caution. Chinese officials issued diplomatic condemnations, policy banks quietly reassessed exposure, and internal risk models were revised, but there was no aggressive response. That restraint is revealing. It signals the limits of China's overseas financial power when it collides with U.S. military and institutional dominance. Venezuela exposed a hard truth. Economic influence without security control is fragile. Maps of Latin America may show Chinese capital spread across the region, but power still hinges on who controls ports, pipelines, and enforcement. What looked like a financial dispute is now a strategic lesson, one that Beijing is unlikely to forget as it rethinks where and how it projects power next. For years, China's Venezuela strategy rested on one assumption: regime continuity. As long as Nicolas Maduro stayed in power, the rules of repayment, loyalty, and political alignment would remain intact. That assumption collapsed when Maduro's government finally fell, triggering a political reset that rewrote Venezuela's debt landscape almost overnight. The new interim leadership inherited an economy in ruins and a debt structure filled with opaque deals signed under emergency conditions. Suddenly, agreements that once looked untouchable were placed under legal and political scrutiny. Loans negotiated behind closed doors, oil for debt arrangements without parliamentary oversight, and preferential terms granted to select creditors all became fair game for review. Debt signed under Maduro may now be unwound, including China's sweet terms. This is where the contrast becomes sharp. Under the old regime, loyalty mattered more than balance sheets. China was rewarded for political support with access, influence, and repayment priority. Under the new leadership, pragmatism dominates. The goal is stabilization, legitimacy, and reintegration into global financial markets, and that requires restructuring debt in ways acceptable to international institutions and Western governments. As a result, bondholders and foreign creditors who were once frozen out are now lining up with legal teams and recovery strategies. Multilateral frameworks, arbitration courts, and U.S.-backed restructuring pathways suddenly carry weight again. China, by contrast, finds itself in an awkward position, too large to ignore, but no longer uniquely favored. In any restructuring hierarchy, transparency and enforceability matter. China's loans often lacked both. What was once a privileged bilateral relationship is now being folded into a broader, rules-based debt reckoning. For Beijing, the regime change didn't just topple an ally, it exposed how fragile influence can be when it's built on politics rather than institutions. Back in Beijing, Venezuela is no longer viewed as an isolated failure. It's a warning signal flashing across China's financial system. Policy banks that once lent aggressively abroad are now reassessing credit risk with far less optimism. Losses tied to Venezuela have forced uncomfortable internal questions about how sovereign risk was priced and whether political alignment was mistaken for financial security. China's regulators have responded quietly but decisively. Banks have been pushed to disclose overseas exposure more clearly, stress test emerging market loans, and reassess assumptions about repayment reliability. The confidence that once surrounded China's role as a patient, fair creditor has given way to a more defensive posture. Reputation matters in global finance, and Venezuela has become a blemish Beijing would rather not repeat. The contrast is striking. Previously, China projected itself as an alternative to Western lenders, flexible, non-punitive, and focused on development. Now the reality is harsher. Risk models are being rewritten. Lending is slowing. Deals that once sailed through now face layers of scrutiny, especially in politically unstable countries. This shift is already reshaping strategy in Latin America. Instead of high-risk states, China is tilting toward relatively stable partners with clearer legal systems and diversified economies. The era of betting billions on oil-backed promises is fading. China's financial regulators are now asking, did we get this wrong? The answer matters far beyond Venezuela. As risk tolerance drops and oversight tightens, global lending patterns will adjust. For emerging markets hoping for easy capital, the message is clear. The money is still there, but it no longer comes without strings, safeguards, and skepticism. If China can lose money here, imagine the risks in other fragile states. That's the unsettling question global investors are now asking. Venezuela's crisis isn't an isolated curiosity. It's a signal flare for emerging market debt dynamics. Sovereign debt crises are becoming more common, and Venezuela's case illustrates how debt for resource deals once lauded as creative financing tools are now fraught with geopolitical friction and legal uncertainty. Despite optimism about debt restructuring, Venezuela's external obligations, estimated between $150 billion and $170 billion, include significant exposure to Chinese lenders alongside Western bondholders, forcing a complex creditor web into the spotlight. China's experience in Venezuela undercuts parts of the Belt and Road Initiative's narrative. Beijing poured tens of billions into Caracas through oil for loans and infrastructure deals. But a combination of political upheaval, declining oil output, and shifting U.S. influence now puts those credits in jeopardy. This fuels skepticism about the durability of state-to-state financing when the borrower's institutions collapse or when geopolitical winds turn. Investor sentiment is shifting too. Private and official creditors alike once embraced resource-backed financing for its stability and collateral. Today, such deals are being re-evaluated in light of odious debt challenges and the potential repudiation of contracts under new regimes, potentially sidelining creditors without strong legal protections. Analysts suggest future credit models will prioritize enforceability, transparency, and risk premiums that reflect political volatility, especially in countries with weak governance or heavy reliance on single commodity exports. For Chinese overseas investment more broadly, this could mean a pivot toward stable partners with stronger legal systems and away from distant high-risk loans. Countries like Brazil or Mexico may look more attractive than resource-rich but institutionally fragile states. The broader lesson? In today's interconnected markets, financial risk isn't just economic, it's geopolitical, legal, and strategic. And Venezuela is now Exhibit A. The story of China's losses in Venezuela is more than a headline about billions at risk. It's a case study in how global finance intersects with geopolitics, legal frameworks, and shifting power balances. When Beijing extended massive loans in exchange for oil, it was betting on continuity, of leadership, of contracts, and of oil flows. What it got was disruption, reshuffling of power, and an urgent debt reckoning that no one fully anticipated. Looking ahead, several scenarios could unfold. Debt restructuring might be negotiated with significant haircuts for creditors, including China, under legal doctrines like odious debt, where agreements signed under a collapsed regime are challenged or rewound. Alternatively, some Chinese assets or future oil entitlements could be restructured into hybrid deals with Western investors or multilateral institutions, minimizing losses while integrating Venezuela back into global capital markets. Whichever route plays out, the outcome will redefine creditor hierarchies and negotiation norms for years to come. For China, this episode may catalyze broader reforms in how overseas lending is approached. with heightened attention to political risk, legal safeguards, and diversified investment targets. For the global financial system, Venezuela underscores the need to incorporate geopolitical stress tests into sovereign risk models. And for investors, it's a stark reminder that no debt is truly risk-free when national strategy and geopolitics collide. So ask yourself this: if the world's second-largest economy can be forced to the negotiating table over failed loans, what does that mean for the next frontier of global finance? The answer could reshape emerging market investment, creditor rights, and the very architecture of international lending in the decades ahead.